Troy Sharpe here, CEO of Oak Harvest Financial Group, along with our Chief Investment Officer, Mr. Chris Perras. Reason for today's video is to reach out to you and talk a little bit about why the markets have been volatile lately, what we've been doing over the past week or so to position the portfolios to move forward for the second half of this year, and also to always keep you connected to your money, because our number one job is to protect what you've spent an entire lifetime working for. So we've had this massive run-up, Chris, in August, and we talked about if the markets go too far too fast, that we could be in line for a pullback, and that's kind of what we're seeing right now. What has led to some of the volatility really in the markets recently?
Yep, in the past week and a half, we've seen an increase in volatility to the upside at first, at the very end of August and the beginning of September, and then more recently to the downside. Investors love upside volatility. They don't think it's volatile, but on the downside, they always, when the market goes down, I think the NASDAQ went down 10%, point to point in about 3 trading days. They consider that volatile. So we're in the dead zone of September, the dead zone of third quarter. There's not any companies reporting earnings. Stock buybacks are lower. You get a window for insiders to sell. You get the election coming up in 6 to 8 weeks now. And some people got out over their skis in a lot of these high-flying tech stocks. The big ones that everyone knows, the Microsofts and Googles and Facebooks. We all know those, but there's a lot of other ones under the surface that are growing at 50 to 80% a year. And you had some people taking positions that we refer to jokingly in the circles called the Texas hedge, where they might be long a stock and they also go out and buy call options. There's a big article out recently about a company called SoftBank, which is a big tech investor over in Asia, owning a lot of these big tech companies and doing just that, creating a lot of upside volatility. And we've just seen that all kind of sucked out in about 3 days at the end of last week and beginning of this week.
But that's really important what he just said. First, when he talked about volatility, it's not just volatility to the downside. When stocks rise 10% in a month, that's volatility. Now, we appreciate that because we see our portfolios increasing in value, especially when the run-up is primarily concentrated around some of the big tech stocks. So Amazon, Facebook, Google, Microsoft, Netflix, Tesla. Tesla's been on a tear, obviously, and I saw the other day it was down 30% or so. And that's upside volatility, and that's good to see, but we need to realize as long-term investors, we need to realize that that is volatility as well. So volatility doesn't just go to the downside, and that's what a lot of people are afraid of oftentimes in retirement, is the downside volatility. But we really should be concerned about upside volatility as well, because that's almost a harbinger of things to come a lot of times. When we see that volatility rising up, a lot of times we're going to get a retracement of that upswing. And we've been talking about this, as I said, in the second half outlook. If you go back under the Oak Harvest view, it's on our website. And we said if the markets run up too far too fast, we should expect to see some consolidation and some retracement or giving back some of those gains. Now, something else you said there talked about seasonality. So this is pretty normal what we're going through right now. It's been a bit more quick than usual because of the big run-up with the upside volatility we saw in August. But seasonality-wise, it's typical to see the markets go quiet and even pull back a little bit in this time period after earnings have been reported, stock buybacks have stopped, insiders are allowed to sell, take advantage of some of the run-up that they've seen recently in their stock price. So the seasonality thing you touched on there is what we alluded to, not only in the first half outlook, but more recently in the second half outlook, which again, you can find on the website. So when we look at the stocks that really have led this rally, I mean, the NASDAQ has, been at all-time highs recently, rebounded much more quickly than some of the other indices. What should the investor, what should our clients, what should they be looking for when it comes to performance over the next, let's say, 6 to 8 weeks leading into the election? Not just with these tech stocks, but the overall market in general.
Well, the normal seasonality into this election time period would have the market down pretty much just retracing August. So you can call that down if you absolutely nailed the peak last Wednesday, which I think was 3,585 or something like that on the S&P 500. Retracing August would put you back at 3,285. So literally 20 trading days. That would be 10% peak to trough. Would be very normal given the rapid ramp we had right at the end of August, early September. But also would set up a great buying opportunity for the fourth quarter and for 2021. Because what we're seeing this year is very, outside of the COVID dramatic drop off for 20 days, is very normal as far as seasonality. We talked about a summer rally when other people, I think, weren't talking about it. We got it. The peak came on payday pretty much at the end of August, and now we're in this dead zone that is likely to be here for a good 4 to 6 weeks as people get concerned about the election. But we view that as an opportunity. People were not looking to buy Caterpillar and John Deere, 2 months ago. Those were the names that we were interested in because of the potential for some spending next year, regardless of the outcome of the election.
So when we look at what we've been doing, and this is important to understand, what we've started to do, because some of the tech stocks, especially the Apple, the Amazon, the Facebook, those companies, they started to become a larger and larger position size inside the overall portfolio. So we want to keep our position sizes around 2%, 3%, maybe 4%. A lot of these positions, because of the accelerated growth that we've had in July and August especially, started to become 6%, 7%, maybe 8% of your portfolio. So what we started to do last week was trim some of those position sizes, rebalance the portfolio to bring it more in line with an appropriate risk level for having money in an individual company or an individual security. Even though they've been on a tear, our number one job is to manage risk. So what we started doing last week was repositioning some of the excess gains that we've made inside those companies into a cash position, essentially, to take advantage of this volatility that we do see possibly continuing up to the election. And just to put a range on that, what you just said, so the August retracement brings us to about 3250 in the S&P 500, give or take. So don't be surprised if the S&P 500 retraces a bit more, possibly down to around the 3250 range. This is normal, this is healthy, it's nothing to be concerned about, but it does create opportunity for us to take that cash that we've raised over the past 5 to 7 days, and we're going to be patient with this, as we always are, and start to cherry pick the companies that we really feel are undervalued and present good growth opportunity, good dividends, and also that we expect to be a benefactor of what the Federal Reserve is doing, which we'll talk about in a little bit.
Yeah, we run diversified portfolios, so we don't run 50, 75% concentration in technology. We don't run 10% positions, in technology stocks individually weighted. We will own some industrials, we will own some consumer staples, we will own healthcare stocks, which means the whole portfolio is not going to go up at the same rate. Some stocks will be going up, some will be going down, but we look to construct portfolios that are diversified. So when events like last week, the second half of last week, the beginning of this week happen and technology falls 10% in 3 trading days, it's not gut-wrenching. Your whole portfolio doesn't go down 10% in 3 trading days. There's the cushion of these other companies that can offset it.
So we've been rebalancing the portfolios, taking some of the outsized gains that we've made in some of those technology stocks starting last week on, I believe, Tuesday, Wednesday, Thursday timeframe, and repositioning those. It's just into a holding pattern right now, into cash and cash-like instruments, because we do expect this volatility quite likely to continue, possibly the S&P retrace back down to early August levels, which again would be normal and healthy. And then we're going to be able to redeploy that money to take advantage of those opportunities. And one of the things that we have working in our favor, which the market will be a big, big benefactor of, regardless of who necessarily wins the presidency, And I would like to also point out that the Senate this year is an equally as important race, if not more so important than the presidency when we're talking about the stock market. It's very, very important to differentiate our personal views and our political beliefs and how we feel if the election goes one way or the other could impact the moral direction of the country, the social, cultural direction of the country, from what the stock market is going to do. Very, very important as investors that we delineate the direction of the stock market from the social impact, cultural impact, and try to eliminate our own biases when it comes to politics. The stock market cares about our companies growing. Are they first earning profits? Number two, at what rate is the growth of those profits? But number three, and this is probably the biggest concern of the markets right now, maybe concern isn't the right word, but the number one motivator for future stock market growth, and that's what the Federal Reserve is doing. So if you look at the chart that we're putting up right here, back in 2008, you see the gray area in the chart. That was the Great Recession from end of 2007 through 2009. You see it took the Federal Reserve several months before they injected the liquidity. And that blue line on the screen, that's the amount of money that the Federal Reserve has essentially printed. And when we see what they've done then, the stock market from the beginning essentially of the Obama presidency through 2016, we see that blue line increasing. That's the amount of money the Federal Reserve is putting into the marketplace, directly and indirectly, into the economy. The stock market did really, really well, despite President Obama having a higher tax environment for individuals, a lot more regulation. Because of what the Federal Reserve was doing, as seen in this chart, the stock market performed very, very well. I believe it averaged 13, 14, 15% a year under President Obama, despite the anti-business type political agenda. Now, when you look to the end of this chart, 2019, we see two things I really want to point out. One, as soon as the gray line and the gray space starts, the Federal Reserve acted immediately. They acted much more quickly than they did back in 2008. And if you look at the magnitude of money that has been directed into the stock market, directly and indirectly, it gets into the stock market, but it's going into the economy. You see that it's 3 to 4 times what they did in 2008. And we still have more stimulus likely on the way. And the Federal Reserve says they're standing by, ready to do whatever is necessary to support this economy. And what we hear is also they're saying we're going to support the stock market. And that is why when we look at what is the stock market most likely going to do in the fourth quarter of this year, in 2021, and really even out through 2022, because all this money doesn't immediately make it into the markets and the economy. It takes time, and it goes out into the marketplace over not months, but years.
It definitely takes time. It's interesting because you can follow the money, and it flows into certain stocks for a while because the market is concerned that no one's ever going to go shopping at the mall again, right? So the money flows into technology stocks where you don't have to go shopping at the mall. You can shop on your phone or you can shop at home. And it does that for 6 months. And then historically what happens is the economy does start to pick up, and the real economy starts to pick up, and people are like, hey, I am going to go to the mall. I am going to go buy something. I am going to go out to a restaurant. I am going to go buy a $250,000 Caterpillar tractor to build a big construction site. But those types of investments tend to lag the first big wave. And what we've seen with the Federal Reserve into the stock market is that first big wave of Federal Reserve money that backstopped the economy, also backstopped the stock market and bond market. It largely went into technology stocks and very fast growth stocks that benefited from the shutdown in the economy and the virus. And now what you're seeing is behind the scenes is the money is starting to move slowly into the real economy where money gets spent on big capital investment that is kind of a multi-year trend. You go out and you spend $250,000 on a tractor. you're not looking for a return in the next 3 months. You're saying, hey, I'm going to own this tractor for 3 years or 5 years, and how many projects am I going to actually be able to use this tractor for and amortize that tractor over a multi-year period. And behind the scenes, that's happening. I mean, Deere is at a new all-time high, and people don't go out and buy big farm equipment just to plow a field for a season. They do it for multiple years, and those are really good leading indicators, but they're hard to see because you turn on the TV and 90% of the news people want to talk about technology stocks because they're going up 3, 5, 10% a day. In some cases, I think Zoom reported their quarter and it went up 35% in a day. Now it's also gone down 30% in the last 3 days. So, most of the big, more established companies that have been around the stock markets, they're not going to have those big moves, but they're also not going to have those moves on the downside either.
And that's why we run diversified portfolios. We're not trying to wave a magic wand here and double the amount of money that you have invested with us overnight. That requires way too much risk, because if you wave that same magic wand and cut your lifetime savings in half by being imprudent and making investment moves all into one concentrated sector or one concentrated stock, that's how you ruin lives. That's how you ruin retirement. So that's why we run diversified portfolios. So just to recap here, in our second half outlook, we talked about the expected pullback through September and October if we go too far too fast. Mm-hmm. So what's happening in the marketplace right now, it's not unexpected. We've been talking about it for several weeks. If you've been listening to the podcasts, if you've read our second half outlook. So this is not a normal. This is something that we have expected. What we're doing, not necessarily in response to this, but because some of the positions that we've owned have grown to outsized position sizes inside the portfolio. Starting last week, we trimmed down some of those positions, created some cash to take advantage of the volatility that we anticipate to continue. The S&P possibly getting down to about 3250. And when we give these guidances, we're not ever trying to hit it directly on the head. It's impossible to time the market, to say this is when it's going to happen, this is the exact level. But there's a feel and some context out there and a lot of things that we see behind the scenes, along with historic analysis of what the market has done in similar situations in the past, which provides some precedents to give us context to these forecasts. So don't be surprised if this volatility continues for the next few weeks, but with the cash that we've raised, by rebalancing and repositioning the portfolios, we're going to look to take advantage of some opportunities created by this volatility over those next several weeks. And then finally, the Federal Reserve, the amount of money that they have injected into the marketplace, the fact that they are standing at the ready to contribute more if necessary. We have congressional legislation hopefully coming out either through executive order or if we can get some type of bipartisan bill in place to further support the economy and those most in need that have been hurt the hardest by the coronavirus economic slowdown. We have that on the horizon most likely as well. It looks like something soon may be happening there. So ultimately, we want you to stay calm. We want you to carry on, understand that there is some volatility in the marketplace, but sticking to your long-term financial plan is the very best way to make it through with peace of mind through these periods of turbulence and volatility. They are healthy for the markets. They are part of the normal market cycle, but this is why we want to make sure you don't have too much money in stocks. We want to have a diversified retirement portfolio of tools, some that have market risk and of course some that do not have market risk. And in combination, we want to create income plans, tax plans, and we look at investments as tools to help us reach our long-term goals of growth, inflation protection, and building up the nest egg, whether it's for inheritance or future medical costs, or just to accumulate more money for you and your family. So stay calm, carry on. What we're going through is expected. It's not unnormal or unhealthy, and we want you to stay connected to your money. That's why we do these market updates. Make sure to share this video with a friend or family member if you think they could benefit from some of the insight that we've provided today. Again, our purpose is to keep you connected to your money. Stay calm, carry on with the financial plan, and we look forward to seeing you soon.